You already feel it. Every headline about record debt, every warning about deficits, every promise to get spending under control. And yet the number keeps going up. Faster, higher, unstoppable. You think this is about politicians making bad choices. You think it is about greed or incompetence or ideology. That is the surface story. It is comfortable because it suggests a fix. Elect better leaders, pass smarter laws, balance the budget. But the reality is far more structural. Global debt keeps accelerating, not because leaders fail to stop it, but because the system requires it to function. In 3 minutes, you will see the exact 4-step loop that makes this inevitable. And once you see it, you will understand why every attempt to reduce it only makes it grow faster. So why does debt accelerate, even when everyone agrees it is a problem? The answer lies in the design of the system itself. Money, in the modern world, is not a static store of value. It is created through lending. Every loan creates a deposit. Every deposit is someone else's liability. This means the total amount of money in circulation is literally the total amount of debt outstanding. If debt stops growing, money stops growing. And if money stops growing in a system that depends on growth to service existing obligations, the whole structure seizes up. This is not a theory. It is arithmetic. Here is the part nobody says out loud. Debt pays interest. Interest needs growth. Growth needs new loans. Loans create more debt. That is the loop. So when rates rise, the system doesn't tighten. It demands even more borrowing just to stay in place. The catch is simple. When growth slows, the only way to keep the loop turning is to add more debt. That is why debt accelerates, even when everyone wants it to stop. If you are new to this, stop. This is where most people get confused. They think debt is borrowed from existing savings. But in a fiat system, most money is created at the moment a loan is issued. The bank does not lend you someone else's deposit. It creates a new deposit in your name, backed by your promise to repay. That new money enters the economy. It gets spent. It becomes income for someone else. That income is then used to service other debts. In other words, when lending slows, the flow of new money slows with it. If lending slows, new money creation slows. Income growth slows. Debt servicing becomes harder. Defaults rise. The system contracts. This is why every major slowdown triggers a surge in government borrowing. It is not panic, it is stabilization. Watch what happens when rates go from 2% to 5%. In 2008, global debt was about 200% of global GDP. After the crisis, policymakers pledged to reduce leverage. What actually happened? By 2019, before the pandemic, global debt had risen to 230% of global GDP. Then came 2020. Government borrowing surged to support economies. Today, global debt exceeds 330% of GDP. This is not an accident. Every attempt to stabilize the system required more debt. Every rescue added to the total. Every recovery was fueled by new borrowing. The pattern is not political. It is mechanical. But what if the system could just switch to a different model? Why not create money without debt? Some systems do. Central banks can purchase assets directly. Governments can spend newly created currency. But these tools are used sparingly because they carry their own risks. Direct money creation can undermine confidence in the currency. It can trigger inflation, if not carefully calibrated. It can blur the line between fiscal and monetary policy, raising questions about independence and accountability. So the default mechanism remains lending. Debt is the path of least resistance. It is familiar, it is controllable. and it keeps the loop turning. So why doesn't growth just outpace debt? Because the relationship is not linear. As debt levels rise, a larger share of new lending must go to servicing existing obligations rather than funding new productive activity. This is known as the marginal efficiency of debt. In plain terms, it means each new dollar of debt generates less and less return. We are now in a period of declining marginal efficiency. That means more debt is required just to achieve the same level of growth. The acceleration is not optional. It is mathematically necessary to maintain the same economic output. Here's the hidden constraint. The system is running on empty. In practice, this plays out in 3 channels. First, the private sector. Households and businesses borrow to invest and consume. When confidence is high, lending expands. When confidence falls, lending contracts and growth slows. Second, the financial sector. Banks and shadow lenders create credit to facilitate transactions and leverage positions. When asset prices rise, collateral values increase, enabling more borrowing. When prices fall, collateral shrinks, forcing deleveraging and contraction. Third, the public sector. Governments borrow to stabilize the economy during downturns, to fund long-term investments, and to service existing debt. When private demand weakens, public borrowing fills the gap. These 3 channels are interconnected. A slowdown in one triggers support from the others. The total debt rises. But what changes first? Private debt, corporate debt, or sovereign debt? The answer depends on the cycle. In the early 2000s, household debt drove expansion. After 2008, corporate debt took the lead. Since 2020, sovereign debt has been the primary accelerator. This rotation is not random. It reflects where the capacity to borrow still exists. When one sector is maxed out, another must pick up the slack to keep the system moving. This is why debt does not just grow, it migrates, and the total keeps rising. This is why pay it down backfires. When you try to pay down debt aggressively without new lending elsewhere, you remove money from circulation. Income falls. Servicing the remaining debt becomes harder. The ratio gets worse even as the nominal amount drops. This is the paradox of thrift on a global scale. Austerity measures often lead to higher debt-to-GDP ratios because the GDP shrinks faster than the debt. The system fights back. Now that you see the pattern, look at the present reality. Global interest rates were low for decades. This made debt servicing manageable even as totals climbed. But when inflation returned in 2021, rates rose. Suddenly, the cost of servicing existing debt increased. Refinancing turns yesterday's cheap debt into today's expensive bill. Governments that borrowed at near zero rates now face refinancing at much higher yields. Companies that issued cheap bonds must roll them over at punitive rates. Households with variable mortgages see payments jump. The system does not break immediately, but the pressure builds. And the response, functionally, is to borrow more to cover the higher costs. This is the acceleration in real time. So why doesn't the system just reset? Why not allow a wave of defaults to clear the deck? Because the cost of a disorderly reset is seen as unacceptable. Defaults trigger bank failures. Bank failures trigger credit freezes. Credit freezes trigger deep recessions. Recessions trigger social and political instability. The incentive for policymakers is to avoid the break at all costs. So they extend, they pretend, they inject liquidity. They add debt to prevent a collapse that would make the debt problem worse. This is not short-term thinking. It is risk management under extreme constraints. The path of least resistance is to keep the loop turning, even if it means higher totals. But what happens when the loop can no longer turn? This is the question at the heart of every major economy today. Debt service costs are rising, growth is slowing, demographics are shifting, productivity gains are modest, the marginal efficiency of debt is low. In this environment, adding more debt generates less growth, which makes servicing the total harder, which requires more support, which adds more debt. The feedback becomes self-reinforcing. This is not a prediction of imminent collapse. It is an observation of mounting pressure. The system can absorb stress for longer than most expect, but the direction is clear. This sounds alarming, but understanding the mechanism is empowering. Once you see that debt acceleration is structural, not accidental, you stop waiting for a political fix that cannot come. You stop blaming individuals for outcomes that are systemically determined. You start positioning for a world where debt continues to rise, where currency values adjust, where asset prices reflect the flow of new credit. You do not need to predict the end point, you just need to navigate the path. If you understand this, you stop chasing headlines and start tracking flows. Let's go deeper into the mechanism. How exactly does new debt enter the system? Through the banking sector. When a bank approves a loan, it creates a deposit. That deposit is new money. It gets spent. It becomes income. That income is deposited elsewhere, enabling further lending. Money creation speeds up or slows down with lending. The central bank influences the process by setting the price of reserves, but it does not directly control the volume of lending. That is determined by demand for credit and the willingness of banks to extend it. When confidence is high, lending expands. When confidence is low, lending contracts. And the central bank must step in to provide liquidity directly. In 2020, this dynamic played out globally. Private lending froze as uncertainty spiked. Governments stepped in with guarantees and direct spending. Central banks purchased assets to keep markets functioning. The result was a surge in sovereign debt and central bank balance sheets. Private debt growth slowed, but public debt accelerated so sharply that the total rose. This is the migration in action. When one channel clogs, another opens. The total flow must be maintained to keep the system stable. So why doesn't growth just solve the problem? Because growth itself requires debt in this architecture. To grow, businesses invest. Investment is often funded by borrowing. Households consume more when they can borrow against future income. Governments spend to stimulate activity, funded by issuance. Growth and debt are codependent. When growth slows, more debt is needed to achieve the same expansion. When debt levels are already high, the same amount of new borrowing generates less growth. The loop becomes less efficient, requiring more input for the same output. This is the acceleration trap. But what if productivity could break the cycle? Higher productivity means more output per unit of input, which could support debt servicing without new borrowing. In theory, yes. In practice, productivity growth in advanced economies has been modest for decades. Technology boosts efficiency, but it also disrupts labor markets, concentrates gains, and requires new investment. The net effect has not been sufficient to offset the rising burden of debt service. So the system continues to rely on credit expansion to bridge the gap. Now that you see the mask, look at the face beneath it. Why is this accelerating now? The timing reflects the end of a long period of declining interest rates. For 40 years, rates fell. This made debt cheaper, encouraging more borrowing. It also boosted asset prices, increasing collateral values and enabling further lending. The entire structure was built on the assumption that rates would stay low or fall further. When inflation returned and rates rose, the foundation shifted. Debt that was sustainable at 2% becomes stressful at 5%. The acceleration we see now is the system adjusting to a higher cost of capital. It is not a new problem. It is an old problem meeting a new constraint. This is the outcome of incentives. Policymakers are incentivized to avoid short-term pain. Markets are incentivized to price in stability. Households and businesses are incentivized to borrow when credit is cheap. No single actor intends to create an unsustainable trajectory, but the aggregate result is a system that requires perpetual expansion to function. Understanding this is not about assigning blame. It is about navigating reality. But what changes first? The perception of risk or the reality of cost? Perception lags. Markets can remain optimistic even as fundamentals deteriorate. Confidence can persist even as debt service ratios climb. This lag is functional. It prevents premature panic. But when the reality of higher rates forces a reassessment, the adjustment can be swift. This is why debt acceleration often appears sudden. It is not that the borrowing spiked overnight. It is that the market finally priced in the cumulative risk. So where does this leave you? It leaves you in a position where understanding the mechanism is your first advantage. You do not need to be a macroeconomist to see the pattern. You just need to recognize that debt is not an aberration. It is the operating system. And operating systems do not change easily. They evolve, they adapt, they accumulate layers. The question is not whether debt will stop accelerating. The question is how the system will manage the consequences, and what you can do to position accordingly. Now that you see the trap, you must look at the exit. But before we discuss strategies, we must fully understand the trajectory. Where is this going? The current path points toward higher volatility in asset prices, greater divergence between sectors that benefit from credit expansion and those that do not, and increased pressure on currencies that lack deep capital markets. This is not a forecast of doom, it is a mapping of incentives. When debt is the primary tool for stabilization, its use will continue until the costs of adding more outweigh the benefits of avoiding a break. We are not at that point yet, but the margin is narrowing. This sounds complex, but the core insight is simple. Debt accelerates because the system that creates money requires it to. Money is debt. Growth requires money. Servicing debt requires growth. The loop depends on expansion. When growth slows, more debt is needed to maintain the same activity. When debt is already high, more borrowing is needed to achieve the same growth. The acceleration is not a policy failure. It is a structural feature. And features do not change because we wish them to. They change when the system evolves. But what if the system could evolve without crisis? History suggests that major monetary transitions are rarely smooth. They involve periods of stress, experimentation, and adjustment. The shift from gold to fiat was gradual, but punctuated by crises. The rise of central banking was incremental, but marked by episodes of instability. The current phase may follow a similar path, not a sudden break, but a series of adaptations. Debt may continue to rise, but its composition may shift, its terms may change, its distribution may evolve. The acceleration may slow, but the direction may persist. Now that you understand the mechanism, you can start to translate it into action. But first, internalize the reality. Debt acceleration is not a glitch. It is the system functioning as designed. Your exposure to this reality is not optional. It affects your savings, your investments, your career, your planning. Every decision you make is made within this architecture. Understanding it does not give you control over the system, but it gives you clarity about your position within it. And clarity is the first step toward agency. The mechanism is clear. The trajectory is visible. The risk is personal. Now we turn to navigation. How do you move within a system that requires perpetual debt expansion without being crushed by its consequences? How do you turn knowledge of the mechanism into a shield? This is not about fear. Fear paralyzes. This is about clarity. Clarity acts. You need a framework that works within a system of perpetual debt expansion, not against it, within it. The first rule is simple. Follow the credit. When debt accelerates, it does not flow evenly. It concentrates in sectors that offer collateral, political support, or strategic importance. Real estate, infrastructure, technology, defense. These are the channels where new money enters. Positioning near these flows does not require insider access. It requires awareness. You do not need to predict the next bubble. You just need to recognize where liquidity is being directed and understand that asset prices in those areas will reflect the inflow before wages do. Here is the part most people miss. You do not need to own the asset to benefit from the flow. You can own the skill that serves the sector. You can own the knowledge that solves the bottleneck. You can position your labor where credit is expanding, not where it is contracting. This is not about speculation. It is about alignment. When you understand where the money is going, you can position yourself to receive some of it. So what changes first? Your portfolio or your perspective? Your perspective. If you still believe that debt is a temporary aberration, you will misread every signal. You will sell when credit expands. You will hoard when you should deploy. You will wait for a return to normal that the system cannot afford. So the first asset you must acquire is realism. The conviction that debt acceleration is structural, not cyclical. That the old playbook of save cash, buy bonds, wait for recovery is obsolete in a world where money is debt and growth requires expansion. This is clarity. Clarity allows you to see opportunity where others see only risk. When everyone is fleeing credit-sensitive assets, you can evaluate. When everyone is chasing the latest yield, you can assess. When everyone is waiting for a fix, you can position. Realism is your edge. Protect it. But what if you do not have capital to invest? What if you are just starting? What if your entire net worth is your next paycheck? This is where most people stop. They think the game is only for those who already have. But the mechanism applies to everyone, and the response can start at any level. The first move is not to buy an asset. It is to reduce your exposure to the downside of debt acceleration. That means minimizing variable rate debt. That means building skills that remain valuable when credit conditions tighten. That means diversifying your income sources so you are not dependent on a single employer or sector. These are not glamorous moves, but they are foundational. You cannot build a shield if you are already bleeding. Watch what happens when rates rise. In 2022, when rates rose and bond prices fell, who was hurt most? Not the person with fixed-rate debt locked in at low yields. Not the person whose income was tied to essential services. The person with variable loans. The person whose job depended on discretionary spending. The person whose savings were all in long-duration bonds. That is the pattern. Exposure matters more than prediction. You do not need to forecast the next move. You just need to structure your position so that you can withstand a range of outcomes. This is not about timing the market. It is about surviving the cycle. So how do you build that resilience? Start with 3 questions. First, where does my income come from? And how sensitive is it to credit conditions? If your job depends on easy financing, new projects, or consumer borrowing, you are exposed. If your skills solve essential problems regardless of the cycle, you are buffered. Second, where is my wealth stored, and how does it respond when debt accelerates? Cash loses value when inflation rises. Bonds lose value when rates rise. Equities can gain when liquidity flows in, but can fall when confidence breaks. There is no perfect answer, but there is a better answer. diversification across uncorrelated exposures. Third, what is my debt structure, and can I survive a shift in rates? Fixed is safer than variable. Short-term is riskier than long-term when rates are rising. Knowing your exposure is the first step to managing it.
But what changes first? Your income, your assets, or your debt? All three matter, but start with the one you control most directly. For most people, that is spending. Reducing fixed obligations gives you flexibility. Flexibility is optionality. Optionality is power in a volatile system. When you have fewer mandatory payments, you can wait, you can choose, you can adapt. This is not about deprivation, it is about strategic freedom. The less you must spend to maintain your baseline, the more you can allocate to positioning for the future. On the income side, focus on pricing power. In a world where debt fuels asset inflation but wages lag, the only way to keep pace is to make your labor scarce. Specialize. Solve hard problems. Build a reputation for results that cannot be easily replaced. The market rewards uniqueness, not effort. You can work 80 hours a week at a generic role and still fall behind. Or you can work 20 hours a week solving a critical bottleneck and thrive. The difference is leverage. Your time is your most non-renewable resource. Do not sell it cheap. Sell it to those who understand that your skill saves them money, makes them money, or protects them from risk. And when the cost of capital rises, adjust your price. The currency may be worth less. Your value does not have to be. Now that you see the blueprint, consider the personal meaning. What does this mean for your daily life? It means you must become a student of flows, not just prices. Not what something costs today, but where the credit is going that will determine what it costs tomorrow. When you evaluate a decision, buying a home, changing jobs, starting a business, ask, how does this position me relative to the debt cycle? Does it increase my exposure to rising rates? Does it align me with sectors that benefit from credit expansion? Does it give me optionality if conditions shift? This is not about complexity, it is about intentionality. Every choice is a vote for the kind of future you can navigate. Vote wisely. Debt is accelerating. Make each decision count. But what if the system changes? What if policymakers find a way to break the loop? What if productivity surges or a new monetary architecture emerges? These are possible, but they are not probable in the near term. The weight of existing obligations, the inertia of institutional incentives, the political cost of abrupt adjustment, these all favor continuity over rupture. So plan for the path of least resistance. Debt continues to accelerate. Liquidity flows to familiar channels. Asset prices reflect credit conditions more than fundamentals. If a break comes, you can adapt. But if you plan for a break that does not come, you may miss the trend that is already here. This is why your cost of living reacts faster than your income, and why fixing the debt never shows up as relief in your monthly budget. So here is your action plan for this month. 3 moves: specific, sequential, scalable. First, map your exposure. Write down your income sources, your assets, your debts. For each, note its sensitivity to interest rates, credit availability, and economic growth. You do not need perfect data. You need direction. Awareness is the foundation. Second, reduce your fragility. Refinance variable debt to fixed if rates allow. Build an emergency fund that covers 3 to 6 months of essential expenses. Diversify your income if possible. A side skill, a freelance channel, a small asset that produces cash flow. These are not exciting moves, but they create the stability required to take calculated risks. Third, align with the flow.
Identify one sector or asset class that benefits from credit expansion and that you understand well.
Allocate a small, disciplined portion of your savings to gain exposure, not to get rich, to learn, to participate, to position. The amount does not matter. The practice does. These steps will not stop debt from accelerating, but they will change your relationship to the mechanism. They will move you from passive observer to active navigator. They will align your actions with the reality of the system. And that alignment is everything. Because the system does not care about your intentions. It only responds to your position. Position yourself where you can adapt, not where you must predict. But what if you make a mistake? What if you misread the flow? What if you reduce exposure just before a surge? This is where most people freeze. They wait for certainty. But certainty does not exist in a dynamic system. The goal is not perfection. The goal is resilience. A small, reversible step in the wrong direction can be corrected. A large, irreversible step based on hope cannot. So start small. Start now. Learn as you go. The market rewards those who adapt, not those who wait for perfect information. Now let's close the loop. You now know the mechanism. Debt pays interest, interest needs growth, growth needs new loans, loans create more debt. You now know the risk. Betting that politics can reverse a structural loop designed to expand. You now know the action. Map your exposure, build resilience, align with credit flows. This is not theory. This is the playbook for navigating a world where debt is not a problem to be solved, but a feature to be understood. The system is not evil. It is a set of incentives embedded in a monetary architecture that evolved over decades. And incentives can be navigated. You do not need to overthrow the system. You do not need to predict its endpoint. You just need to understand its logic and position accordingly. Debt may keep accelerating, but your exposure does not have to. Your resilience does not have to. Your agency does not have to. Do you think the system can keep the loop running at 5% rates? So as you move forward, carry this one phrase with you. Let it guide your decisions when the headlines scream. Let it anchor you when the narrative shifts. Let it remind you of what is truly within your control. Debt accelerates by design. Your freedom does not have to. Guard it.